Hey there guys, so in this video I'm going to be focusing on the Vanguard portfolio allocation models. So I saw this on the Vanguard website and a lot of people are interested in Vanguard, and this is a question that has popped up quite a bit on my channel in terms of portfolio allocations. People have asked what my opinion is. Do I personally like to invest in all stocks, or do I like to invest in bonds or whatever else? And whenever anybody asks my opinion, I just always say it really depends, because it does, and it's personal to everyone. It depends on what your risk level is. So if you don't like taking risk, then investing in 100% stocks is probably not the thing that you want to do, because stocks are riskier. Maybe you want to mix up your portfolio with bonds. It also depends on the time frame that you're looking at. So if you are only investing for a shorter time frame, then it's probably not best that you invest in stocks only, because stocks are much more volatile than bonds are. And it also depends on if you're looking to generate income or not. Bonds are often used to generate income because you get your coupons. Stocks, not so much if you're looking at growth stocks, but potentially if you're looking at dividend paying stocks. So as you can see, there are a variety of factors that play into how you should personally allocate your portfolio. Some people choose to go to a financial advisor to get more of a guidance on this, which I think is great if that's your cup of tea, but some people don't really want to pay a financial advisor like myself, and you just try and figure it out for yourself. But the good thing is Vanguard have these portfolio allocation models to give us a bit of an idea of the types of returns that have been seen in the past, depending on how you've allocated your portfolio. So let's have a look at what Vanguard say on their website. So they have different portfolio allocation models. So they have an income one, they have a balanced one, and they have a growth one. Okay, and so we're going to start with the income one first. And what they are showing is, depending on what your goal is, whether that's income, balanced, or growth, if you were to allocate your portfolio in a specific way, what would the type of returns potentially be based on past data? And we all know past performance does not predict future performance, but it just gives us a rough idea of what we may see. So first of all, for the income portfolio, we've got 100% bonds, which means that someone is invested completely in bonds and not in stocks whatsoever. So the historical return rate from 1926 to 2020 shows that people who invested in 100% bonds had an average annual return of 6.1%. The best performing year over this nearly 100-year period was in 1982, when there was a whopping 45.5% return on bonds. That is crazy. I can't even imagine that. The worst year was in 1969, which saw a negative 8.1% return, which really isn't great when it comes to bonds, because you don't expect to get negative returns. But it goes to show what is possible. And out of all of these years, there were 19 out of 95 years where there was a loss. And that is equivalent to 20%. So 20% of that 95-year period, there was a loss. So that is for the first 100% bond income portfolio. Next, we've got a 20% stock and an 80% portfolio allocation. So it is mostly bonds still, but there are some stocks thrown in there for measure. So the average annual return for the same time period was 7.2%. So we can see that it's slightly higher than the 100% bonds. The best year again was in 1982, and it saw a return of 40.7%, which is interesting because that's less than what was seen for the 100% bonds. The worst year was in 1931, and I believe that was the Great Depression. And this is all using US data, by the way. I think that was around the Great Depression, and the return was a negative 10.1%. So again, worse than what you would have seen for the 100% bonds. And the years with a loss is actually less. So it's 16 years out of the 95-year period, which is equivalent to 17%. So 17% of those 95 years, there was a loss. Again, quite interesting. But I guess what you may look at is the average return is slightly higher having some stocks than the average return of having 100% bonds. Now, for the next one, we've got 30% stocks, so a bit more, and 70% bond. And for this, we see an average annual return of 7.7%. So we can see the pattern here, that as you add more stocks into your portfolio, the average annual return tends to go up. The best year was again 1982, which was clearly a fantastic year. I have no idea what happened during that year. If you know, please let me know down below in the comments. The return was 38.3%, so not as impressive as the other two, but still very, very good. The worst year was in 1931 with a loss of negative 14.2%, so not great. And the years with a loss was 18 out of 95 of the years, which is equivalent to 19%. Now, let's move on to the next portfolio, which is the balanced portfolio. So Vanguard say that a balanced portfolio invests in both stocks and bonds to reduce the potential volatility. An investor seeking a balanced portfolio is comfortable tolerating short-term price fluctuations, is willing to tolerate moderate growth, and has a mid to long-range investment time horizon. So we can see here that for the balanced portfolios, the amount of stocks has increased in compared to that income generating portfolio. So for the first one, we have 40% stocks versus 60% bonds. And again, we're still looking at the historical returns from 1926 to 2020. The average annual return was 8.2% for 40% stocks, 60% bonds. The best year, again, 1982 of 35.9%. Worst year, again, 1931, which is negative 18.4%. Ouch. And the amount of years with a loss is 19 out of 95 of the years, which is equivalent to, 20%. So we can see here that the average returns actually seem to be going up. So if we looked at previously, it started at 6.1%, 7.2, 7.7. As we moved over to the balanced one, we're now increasing to 8.2%. For 50% stocks and 50% bonds, we have an average annual return of 8.7%. So again, incrementally increased. The best year, 1982. I've got a bit of a pattern here, 33.5%. The worst year is negative 22.5%. And the years with a loss is 20 out of 95, which is equivalent to 21%. So we can see here that even though the average annual return is increasing, that the best years aren't as high as we increase our stock allocation in our portfolios, and the worst years seem to be getting increasingly worse as we have more stocks. But really, I guess what you should be looking at is the average annual return. But this also highlights that stocks are more risky because you're going to have worse years overall than you would with bonds. So quickly looking back with 100% bonds, the worst year was negative 8.1% compared to this 50-50 allocation with a worst year of negative 22.5%. Then the last balanced portfolio is 60% stocks, 40% bonds. We've got an average annual return of 9.1%. So we're getting closer to what I like to see as an average annual return. We've got the best year of 1933, so slightly different, of 36.7%. We've got the worst year, again 1931, 26.6%, negative 26.6%. And then years with a loss were 22 out of 95, which is equivalent to 23%. And last but not least, we have growth. So this is what I consider myself. I'm really a growth investor. I have a long-term horizon, and so I feel much more comfortable having a bigger portfolio allocation towards stocks. In fact, I'm 100% stocks, apart from in my target retirement fund, but that's a different story. But in my ISA, it's 100% stocks. So Vanguard say that a growth portfolio consists of mostly stocks that are expected to appreciate, so go up in value, taking into account long-term potential and potentially large short-term price fluctuations. An investor seeking this portfolio has a high risk tolerance and a long-term investment time horizon. So that's me. Generating current income isn't a primary goal. So I speak about that in my Vanguard portfolio updates, that I'm not really looking to generate dividend income right now or coupon income from bonds. I'm just looking to get that growth for now. So for the first growth portfolio, we have 70% stocks versus 30% bonds, and historical data shows an average annual return of 9.4%. The best year was in 1933, and we're seeing a return of 41.1% in the best year, which is phenomenal. But the worst year, which was in 1931, was negative 30.7%. That is tough. Imagine investing and you lose 30% in 1 year on your investments. That would be really, really painful, but it goes to show the risk you're taking when you invest in stocks. The years with a loss were 23 out of 95, which is equivalent to 24%. So slowly going up the amount of years that a loss is seen, but if we're looking at the average annual return, we're also seeing that the returns are getting better the more stocks that you have. The next portfolio is 80% stocks and 20% bonds. The average annual return is 9.8%. The best year in 1933 was 45.4%. The worst year was negative 34.9%. And the years with a loss were 24 out of 95, which is equivalent to 25%. So that means a quarter of those years from 1926 to 2020 had a loss. That's quite a lot. That's 1 in 4. Then last but not least, this is where I'm currently at. We've got 100% stocks. So the average annual return is 10.3%, which is why in general you hear people say the stock market on average turns about 10% or 8% after you take into account inflation. So this is generally where those numbers are coming from. The best year saw a whopping 54.2%, and that was in 1933. That's insane. Wow. The worst year was negative 43%. So yeah, that's quite depressing. And the years with a loss were 25 out of 95 years, which is equivalent to 26%. So I hope this video has been helpful in showing you what the average historical returns have been according to different portfolio allocations. If you are someone who is considering investing and you haven't yet, and you're not sure what you should do, I'm hoping this is a good start for you to figure out, okay, what do I feel comfortable with? How much risk do I want? What kind of average annual returns would I prefer to get? And for those of you who are already invested, maybe things are changing for you. Maybe you're now looking to get a bit more income, and so you need to shift a bit more from stocks to bonds, or maybe you're interested in growth now and you wasn't before. So as I've said, for me, the season of life that I'm in, I'm 100% growth, but that does not mean I will be there forever necessarily. I may be, but I may not be. So this has been a lot longer of a video than I expected, but I do hope you've enjoyed it. I hope you found it useful. I've got it linked down below if you want to have a look for yourself. And yeah, so that's it. And I look forward to seeing you in the next video real soon.